Did you know that in New York City, it's not the banks that determine how much your down payment's going to be? So who does determine it? Well, that's what we're going to talk about here in this video. By the end of this video, you'll understand what to expect in terms of how much your down payment is going to be for New York City apartments. If you haven't already, please hit the subscribe button and take a look at the description box for all sorts of ways on how to get in touch with me and also for a link to schedule a private consultation. So let's get started. One of the most common misconceptions about buying in New York City, especially if you're moving here for the first time, is that the banks tell you how much you can put down. So I don't know, they may tell you 3%, 5%. That is never the case in New York City. It is the boards of the individual buildings that determine what your down payment must be. So in New York City, for the most part, we have two different kinds of buildings, condos and co-ops, and there's a link to a video that I did that explains the differences between the two properties in depth. With condos, here's what you should expect. For the most part, they're going to ask you to put 10% down on the purchase price. So 10% down for condos. With co-ops, you're buying shares in a company that owns the building. So the boards of the co-op want to make sure of a few things. They want to make sure that that shareholder coming into the company is financially secure. And they also want to create stability in the co-op community. In other words, they think that by putting more equity into your investment, the less likely you'll be to turn around and sell it within 6 months or so. They want to create a very stable financial community. So with co-ops, general rule of thumb, you should expect to put 20% down of the purchase price. Now there are boards that allow 10% down in very competitive areas of New York City. You might find boards that want 25%, 30%, even 40% down. Point being is that the boards can make their own rules when it comes to down payments. Co-op boards are also going to look at a couple of different other financial things. They're going to look at your liquidity. In general, co-ops usually want to see 2 years, up to 2 years, of mortgage and maintenance payments in the bank at the time of closing. So the equivalent of 2 years of mortgage and maintenance in the bank. What you do with that money the day after you close is totally up to you. But again, they're just wanting to make sure that you're financially secure enough to come and purchase shares in that building. Again, rules vary from board to board. Some don't have any liquidity requirements. Some have even stiffer liquidity requirements. The other thing they're going to look at is your DTI, your debt to income ratio. So again, they want to make sure that you're going to be able to afford to support your portion of the shares in the building. So they want to see a pretty low debt to income ratio. Now a bank may go up to 40% DTI, but a co-op may say, nope, we only want to see 25%. We want to see 20% DTI. Some boards, again, don't look at this very closely, but many do. Point being is that you need a great team. You need a great agent. You need a great mortgage broker and a great attorney who all understand the New York market and can help you really navigate what the boards are going to expect when you're purchasing both in a co-op and a condo. 10% down for a condo, roughly 20% down for a co-op. And that's your answer. Okay, so hit the subscribe button if you haven't already, and check out the description box below for a whole different ways of getting in touch with me directly, as well as scheduling a private consultation. And thanks for joining.